we left off this morning, the other day, whatever the day this is, we left off with pretty much accounts receivable and sales. We talked about sales, earning sales, and putting them on account. In order to do that, we debit accounts receivable / the customer, and we credit sales revenue or whatever revenue account sales is associated with. Of course, same concept with the journal entry. If we made cash, if we received cash for the sale, debit the cash, we're bringing in cash, and we credit the sales. Whether you make these descriptions on here or not is completely up to you. That is mainly for your information, maybe to keep it straight in your head as far as what we're doing in that particular journal entry. I want us to move on to what we call sales tax payable account. And all sales tax payable account is that we have to pay sales tax on that sale. So same concept, we have an accounts receivable, we have sales, but unfortunately we have what we call a liability account to pay that sales tax. So it is a liability account to account for the sales tax on merchandise sold to customers. I don't believe this chapter, we'll be talking about this later in accounting 3, I believe. Pretty sure that we're not going to deal too much with the payable itself as far as paying it out. What we're doing is accounting for the liability with the matching concept. So don't worry about this once paid. I have a slide coming up on this once paid. It's going to sort of talk about that once paid. So our journal entry, very similar to what we had earlier. We have accounts receivable, we have a customer. Again, make sure you put the customer name, company name, whatever that is, because once we put these on the ledger, you're going to need to be able to distinguish which customer is which on your ledgers. Whoa, I get for drinking a cup of coffee. So the accounts receivable, the debit is going to be $105. And sometimes I've always mentioned do the debit first, do the debit first, do the debit first. But in some cases, you may not be able to figure out what that debit number is. So leave room for the debit, maybe figure out the sales or put it off to the side to figure out what the sales and the accounts for the sales tax payable is going to be. In this case, it's pretty simple, cut and dry. We had sales of $100. We have sales tax payable of $5. Again, that's a liability. Remember correctly from our normal balances that DC Adler, cannot emphasize enough that DC Adler. If you need to, write that down in your paper, put it on a post-it, use that post-it every time you're doing these journal transactions, anytime you post into the ledger, that way you know what that normal balance is supposed to be. In this case, a normal balance of an asset is a debit. That makes sense, but it does go both ways, but we are putting it on account. The normal balance of revenue is a credit, sale, and a normal balance of a liability, the LUR, and DC Adler, is a credit. So we're going to be doing several of these transactions in the A and B series, so make sure you understand this transaction as it sits right here. And I did emphasize, although we're not going to deal with it in here, I'm pretty sure we don't deal with it in here. Don't call me a liar. But I threw it in this slide because once it's paid, remember we talked about taxing authorities in the other chapters, and we'll be talking about this in payroll as well. Once that sales tax payable is paid, we turn around and debit the payable, which gets rid of the payable, and we turn around and credit the cash, which obviously crediting the cash gets rid of the cash. So we're going to move into sales returns and allowances. We're not going to get as far in here as I thought we were going to. I was looking at the PowerPoint, and I'm thinking that we're not going to be able to make learning objectives 3 and 4 today. I will hopefully have at least videos put up for it. That way you can take a look at it ahead of time if you like. And as well as we have B series, which I have scheduled to be due on the 30th. So that's plenty of time between now and then in order to complete the A series and have you start working on the B series. Remember, just like me, you guys don't have a long drive into school anymore, so take advantage of that time and not just sleep in. Okay, take a deep breath. In through the nose, out through the mouth. We're going to be talking about sales return and allowances as well as sales discounts. Both of these accounts are what we call contra revenue account. Now, if you remember correctly on contra, you mentioned, I remember Hannah, you mentioned something about horses and contra. First thing I think of is the Iran-Contra affair back in '79 with Lieutenant Oliver North. So we're on different wavelengths with it, but just know that a contra revenue account, anything contra, when it comes to accounting, is if you have a normal balance as a debit, a contra means that normal balance is a credit. Not necessarily normal balance, but that balance is a credit. The entry is a credit. Let me correct myself with that. Not necessarily the normal balance is a debit or credit, but the entry is the opposite of the normal balance. Maybe that's the best way to put it. The entry for a contra revenue or a contra asset or contra liability account is the opposite of the normal balance. Now we run into a few here and there, so don't panic that we have 15, 20 of these different accounts. But what we deal with in accounting 1, 2, and 3 is mainly like a half a dozen accounts. Sales returns and allowances, like I mentioned, is a contra revenue account. So in this case, since revenue is normally a credit, we're going to be entering in these sales returns and allowances as a debit. We'll also be talking about discounts here in a couple minutes. Same concept with the discount. Sales discount is a contra revenue account. We will be entering in as a debit. All it does is reduce the amount of that sale for whatever reason. One of the reasons, returns and allowances. And number 2 is discounts. So this slide just shows you exactly that we'll be entering a debit for these sales returns and allowances. Moving forward with it. Of course, moving forward with it, let's take a look at this example. I don't always use these examples from the PowerPoint, but in this case, this happens to be a very good example. So Wilma Cuts returns a riding helmet. The selling price was $46 plus $2.30 sales tax. But pretty much all we're dealing with that is turning around and we're going to debit sales returns and allowances for the selling price of $46. We're going to debit the sales tax payable for $2.30, and then we're going to turn around and credit the accounts receivable account for Wilma Cuts for $48.30. It's easier to flip on the general journal entry and show you exactly what we're talking about here. Our sales returns and allowance, again, it's a contra asset or it's a contra revenue account. We debit for the $46. That was the selling price. We turn around and debit the sales tax payable because we need to remove that payable. That liability is no longer there. And then we turn around and credit the accounts receivable, which gives Wilma Cutts back her accounts receivable on our records. Now, this doesn't necessarily mean, remember, this is an accounts receivable account. There's no cash exchanged here. This is just a matter of accounting for the monies. So instead of $1,000, she now owes us $900. Really, I had to pick $1,000. $951.70 if she had $1,000 on her accounts receivable. Similarly, we're going to be dealing with what we call sales discounts. Again, it's a contra revenue account. This has a debit balance and is reported as a deduction from sales on the income statement. It's something I forgot to mention earlier. I want to make sure you understand somewhere in these slides. It should be reported, shown as a deduction from sales on the income statement. So if we have $1,000 in sales and we have $100 in returns and allowances, we technically only have $900 in sales. Then, moving forward, if we have a discount of another $100 for whatever reason, we're going to take that out of our $900 in sales. So now we only have $800 in what we call net sales. So we had gross sales of $1,000. Now we only have $800 because of the sales and allowances that were taken out, as well as the discounts that were taken out. Let's talk about credit terms. We will see these in QuickBooks, but credit terms you should be familiar with, and you may be familiar with in any given business. A lot of businesses use these credit terms. Some may not, depending on whether you're extending credit to folks or not. In this case, it looks like 2-10 net 30, which means you're going to get a 2% discount if you pay it within the next 10 days. If not, or even if you do, well, there are partials. It's not even if you do. In this case, it's all or nothing. You're getting the discount at 2% for 10 days. If you don't take advantage of that discount, the net, or the rest of that, is due in 30 days. And the reason I mentioned partials is because we'll talk about partials somewhere down the line. But we're not going to get too far into that today. All we're mainly doing is doing the journal entry for accounts receivable for the discounts. And of course, like I said, the rest is due in 30 days. Here's a combination of several of them. We got 2% within 10 days, net 30. You got a 1% 10 days, net 30. And you got a 2% if paid by the end of the month. And of course, the net is due in 60 days, 3% within 10 days after the end of the month, and then the net due is 60 days. Different companies use different ones. I tend to see this 1-10 net 30 quite often. Maybe the 210. I don't see too many of the end of the months. But just be aware of, it all depends on the company and their terms and how they extend credit. Of course, companies have to be very careful in how they extend credit to folks. So let's take a look at the journal entry with a cash sale. It wasn't necessarily a cash sale. I wanted to verify exactly what we were doing here because the prior slide was talking about what was going on. I like to show just the journal entry and just let us figure it out for the most part. So they returned this item for cash within, or they paid the item for cash within the amount of time. So we received the cash of $98, even though they owed us $100. We received cash of $98, and we turned around and we did a debit for sales discounts because they paid within that 10-day, 20-day period, whatever the discount date was. They paid within that time frame. And of course, we give them the whole credit on their accounts receivable because it reduces their accounts receivable by $100. In many ways, this is what we call the price of doing business. Yes, it sucks that we're only getting $98 because we gave them a discount. But you know what? We got $100 worth of sales, and then maybe they will tell another person, and they will tell another person, and that's sort of how it floods into the system as far as getting sales. So like I mentioned earlier, when it comes down to sales, we have a gross sales. As an example, we have gross sales of $38,500. We have less sales returns and allowance of $200. We have less sales discounts of $140. Subtotal those to equal $340. Subtract that $340 from the $38,500, and we get net sales of $38,160. We have two of these problems that we'll be doing. In fact, we might do both of those problems in A series. Let's see, I think there's two problems in the A series, 12A as well as maybe 3 or 4A. We'll take a look at that here in a minute because we only have a couple more things to go over. But this is all we have to do on the income statement. We'll see this on the income statement moving forward. Before, we just saw simple sales of $38,000, that was it. Now we're dealing with these sales returns and allowances, sales discounts, which takes away from our gross sales. Take those two away, then we end up with net sales. A couple additional notes on here. We're going to jump into a couple exercises. We're going to be doing 3A, 4A, as well as, I'm pretty sure I'm doing this on the fly here as I'm looking through my book. I think we'll end up doing 12A as well. I believe 12A is based on net sales and gross sales, what we just spoke about. Of course, when I'm looking for something, I cannot find it. Oh no, never mind. 12A deals with the schedule of accounts receivable. I'm thinking it dealt with net sales and gross sales. So let's take a look at 3A and 4A real quick. I'm going to post a separate video for the answers for 3A and 4A because this one's getting about 15-20 minutes. And I don't want to do these videos longer than 15 to 20 minutes because the attention span of myself is null and void. I can't imagine you listening to my voice at the same time thinking that, oh my gosh, you have 2 hours worth of him talking. No, so I'm trying to keep them about 15 to 20 minutes max. So I'm going to start a whole new video on these assignments for the A series.